Happy Friday, everyone. We're hoping that you had a fantastic week this week. So today we have a very important topic, and is you may have heard about the words Fannie Mae and Freddie Mac, and you may be wondering why are these two entities play such important role in the real estate market and especially in the mortgage industry. Well, today we are going to walk with you detail and step by step about these two important entities and the benefits for you to obtain a loan right now. With no further ado, I would love to introduce my team, Roberto Lizarralde and Carolina Bryce, with a special guest from Loan Depot, Luis Arizaga and Mario Serrato. Hello, everyone.
Hello, Monica.
Hello. Hi, Monica.
Okay, Roberto, tell us about Fannie Mae.
My pleasure, Monica. Fannie Mae is another name for the Federal National Mortgage Association, also known as FNMA, which the government created in 1938.
Very good, very good. 1938, wow. Okay, and what about Freddie Mac, Carolina?
Yes, Monica. Hi, everyone. Freddie Mac is another name for the Federal Home Loan Mortgage Corporation, also known as the FHLMC. And this entity was created in 1970.
Okay, so Fannie Mae is older than Freddie Mac. That's an important point. Now, what are the purpose of creating these two entities, Roberto?
Both Fannie Mae and Freddie Mac were initially formed to stabilize the residential mortgage market and expand opportunity for homeowners and affordable rental housing.
Okay, Carolina, and I know that you have something else to add into that. What would be?
Yes, absolutely. The primary business of both Fannie Mae and Freddie Mac is to purchase home loans from lenders. So these lenders can replenish their supply of capital funds and make more mortgage loans to borrowers.
Okay, very good, very good. And what kind of loans do they usually have, Roberto?
Both entities typically buy conventional loans with certain loan amount limits and underwriting standards. They also may buy government insured housing loans such as FHA, VA, and USDA loans.
Okay, and many of you know the economy was affected in 2008. So, Carolina, what happened with these two entities at that time?
Yes, Monica, during 2008, which everybody knows was the global financial crisis, Fannie Mae and Freddie Mac guaranteed over 5 trillion mortgage debt. So during this crisis, the share prices of both Fannie Mae and Freddie Mac went down. And because of that, investors were fearful that they were going to collapse because of the escalating foreclosure rates, and also because home prices were plummeting at that time. The main fear was that both these entities didn't have the capital to absorb all the predicted losses. So in September 2008, Fannie Mae and Freddie Mac were both placed into conservatorship of the Federal Housing Finance Agency, also known as the FHFA, and they became the two entities became under the control of the government.
Okay, very good, very good. Okay, so now you know both of these entities. Okay, but today the role of Fannie Mae and Freddie Mac haven't changed much. Instead, they are very strong in today's market. So, Luis and Mario, talk to us about the benefits of obtaining a loan with these two entities. We can hear you.
Oh. Can you hear me now?
Yes.
Okay. Yeah, we're going to talk about Home Ready and Home Possible, which are the two programs for Fannie and Freddie Mac. Here I'm with Mario. Mario is he knows a lot about the details about these two programs, so I'm gonna let him dive in.
Okay, so Fannie Mae, so the Fannie Mae and Freddie Mac, the reason that most borrowers use those two type of products is because of the low down payment requirement. You can go as high as 97% financing, which means that you only have to do 3% down. You have to be a first-time home buyer in order to get the 3% down option. Otherwise, it's 5% down payment. The other reason why borrowers choose to go with Fannie Mae and Freddie Mac is because the mortgage insurance for both those programs is you can eliminate it. Very different than FHA, where the mortgage insurance is for the life of the loan. In other words, the only way to remove mortgage insurance on an FHA product is by refinancing the loan or selling the home. In other words, somehow paying off the loan. Whereas Fannie Mae and Freddie Mac will allow you to remove the mortgage insurance once you hit 20% equity on your property. And you could do that in a variety of ways. You can pay it down, or you can buy down the mortgage insurance. You have to work with your servicer once your loan is originated and funded. But those are the two main reasons why folks like using Fannie Mae and Freddie Mac. Now, there's a place for not every borrower can get a Fannie Mae and a Freddie Mac loan, but most can. There are times where we do have to put them in an FHA loan, but today is all about Fannie Mae and Freddie Mac. And so two of the programs that Fannie Mae and Freddie Mac highlight the most is one called Home Ready, and that's the one from Fannie Mae. And the reason why borrowers choose this program, or why lenders put borrowers in these programs, is because the mortgage insurance is cheaper. You get a break on the mortgage insurance because you're a first-time home buyer, and the down payment is 3%. Now, in order to qualify for this type of loan, you have to have a 620 credit score, and you cannot make more than $56,640 per year, which is roughly $4,720 a month. So if you exceed that income limit, you will not be able to participate with this program, but you still can get a Fannie or Freddie loan. And we call Fannie and Freddie loans conventional loans. So Fannie Mae's first-time home buyer product, which is 3% down, is called Home Ready. And then Freddie Mac's version of that is called Home Possible. Both programs are almost identical in the requirements and the benefits. So whether you go with Fannie Mae or Freddie Mac is really a function of your credit profile. In other words, when we take your loan application and you tell us that you want to do 3% down and you are within the income limit, what we do is we run you through both Fannie and Freddie engines, and whichever one gives us the most favorable approval is the one that we would use for you. But as far as what your mortgage insurance is going to be and what your interest rate is going to be, 99% of the time, it's identical whether you go with Freddie Mac or Fannie Mae.
Very good, very good. Okay, very good. Is there any questions, Carolina, that you have?
Yes. Could you tell us how does a person, an individual, applies this programs? Do they do it for Fannie Mae or Freddie Mac, or is it a lender or a bank that they have to approach?
Well, they can apply, of course, with us, Loan Depot. Once they apply through our website, we can see which, like Mari mentioned, which one is the one that is more favorable to use. And, depending on credit score, we can see if obviously they apply for a conventional loan. Just to, mention something, once we pull credit, and if credit is not where it needs to be, we can also do a rapid rescore. We can help with that. And we basically look into a credit report system that we have where we can ignore or pay off collections or remove something, pretend that we're removing it, and it will give us a credit score or an estimated score that it will go up to. So that's something that we can do as well.
So you can't apply directly with Fannie or Freddie. They don't originate loans. They use banks and lenders, and so you would have to go through an approved lender.
Okay, very good, very good. That clarification is very important. Okay, so they are like the main umbrella, and they are
Mhm.
under the umbrella. Okay,
Yeah.
good. Okay, so now, does this type of loan apply just for first-time home buyers, or anyone can benefit from this?
No, so Fannie Mae has Fannie Mae can do a loan for a first-time home buyer, a second home, or an investor. But in order for you to reap the benefits of 97% financing, in other words, the minimum down payment, you'd have to be a first-time home buyer, and you'd have to have a 620 credit score, and your income limit has to be less than 56,640. Otherwise, you can still get a regular Fannie or Freddie Mac conventional loan. You'd have to put 5% down.
5% down. Okay, okay, perfect. Can you tell us more about what is a non-traditional credit?
So the credit is 620.
So it's a non-traditional credit.
Oh, non-traditional credit.
Non-traditional credit.
So non-traditional credit is when the borrower does not have, doesn't have enough trade lines or credit history to generate a credit score. So what we do is we build a credit score for them by asking them for their cell phone bill, for their rent, for their electric bill, and we incorporate that into a non-traditional credit report. It won't generate a score, but it'll allow the borrower the opportunity to apply for the loan.
Okay.
And I do want to mention something about that.
Yes.
When you have two borrowers, as long as one of the borrowers has a credit score and the other borrower does not make more than 50% of the income, we do not need a credit score for the second borrower. So that's something that's popular, and I'll give you an example when we would use that. Let's hypothetically say that a person applies for 97% financing on a Fannie Mae Home Ready product, and they don't make enough income to qualify for the home that they want. And so what they could do, they can add grandma that's going to live with them to the loan. Grandma doesn't have any credit, but grandma makes, let's just say $1,200 in Social Security income. We can use grandma's $1,200 Social Security income to qualify for the mortgage, and grandma does not need to have any credit. That's just an example of the flexibility that Fannie and Freddie have on conventional loans for first-time home buyers.
Very good, very good. And I remember when we were talking that you said that this type of loans also benefit people with disabilities, right?
Correct.
So
Fannie Mae allows, I'll give you an example, and this happens a lot, where the parents cannot afford to buy a home, but the child can afford to help them buy the home. So typically what happens in a situation like that is that the child has to buy the property as an investment home to let the parents live in it. But Fannie Mae put a rule, a guideline, if you will, a loophole that allows the child to buy the home for the parent as a primary residence. So they could put 5% down. It would go in the parent's name. The parents don't even have to be on the mortgage, but they could be on title. And you can take advantage of the primary residence owner-occupied interest rates. So you can do it for both for a parent and for a disabled child. So for example, if you have a child with autism or a child that's handicapped that cannot generate enough income to buy their own home, the parent can do it for them and still consider it a primary residence without the parent actually having to live in the property.
That's great news. That's great news for some families who have experienced that situation. Okay, so besides that, how is the market moving these days? And especially, I'm sure that with these two great options, you may be running around different type of scenarios. How is the market going as far as buyers, qualifications, and have you seen that they're taking advantage of this possibility that you just shared with us?
Okay, so I'll go back in history just a little bit. You touched on 2008. In that period of time where we had the real estate bubble and we had the large foreclosure problem, a lot of that occurred because Fannie and Freddie were underutilized. We were using loans from alternative lenders that did not require income qualification. And so because of that, that contributed to the problem of the real estate bubble. Today, it's been, we're in 2020, we're 12 years away from, 12, 13 years away from that. So we've had 10 to 12 years of borrowers getting used to providing a lot of documentation. And so because of that, you hardly ever find a borrower that's applying for a loan that doesn't have the right documentation. We're all used to it. We've been asking for it for a decade now. And so it's common. So I say that because nowadays when borrowers want to apply for a loan, we have many mechanisms, many strategies that can help them get qualified. So I would say that if you apply for a loan, you have a pretty good chance of getting approved one way or the other, assuming you have a 2-year work history, you have a decent credit score, and you're ready, willing, and able to buy. If you don't have enough money to buy, that's the easiest obstacle to overcome because there's down payment assistance available. And you can combine down payment assistance with Fannie and with Freddie Mac. That's another great option that they have.
Very good. Very good. Okay. Good enough. We just had a scenario, and now I'm going to bring this up because we had a client who applied for one of these type of loans. And please clarify me if I'm wrong, but these type of loans are not only apply for single homes, but also for condominiums, right?
Correct. Yeah.
Okay.
Yeah, the client that we had, the reason why I used that product was because the rate was better, the interest rate.
Okay.
So,
okay.
So you can do maximum financing, and when I mean maximum financing, I mean 3% down on a condominium as well. Now, when you're buying a condominium, there's a clarification that has to be made. When you're buying a condominium and you're doing the least amount of down payment, not only Fannie Mae and Freddie Mac have this requirement. Not only do you have to get the borrower approved, you also have to get the project approved. So the condo association itself would have to be approved. And how we approve them is by looking at the budget and sending the association a questionnaire that has about 20, 25 questions. So we can ascertain the health of the association. And the reason that situation exists is because Fannie and Freddie want to make sure that the borrower is buying in a project that has a healthy financial outlook. And so because of that, Fannie and Freddie require that we approve the project as well as the borrower.
Very good, very good. Okay, I also have a scenario with a family that is first-time home buyer. Okay, they are living here for almost 2.5, almost 3 years, and they would like to apply for a home for the first time. And their income is low, so I think it would qualify. The credit score is good as well. So the only thing is that this family, I don't think they have 2 years work history, even though they received the W-2. Would that affect this type of project, this type of loan for them to apply?
So the program does require 2-year work history. There are some exceptions, and I'll tell you what they are. The first exception is if they were in school. If they could provide evidence that they were in school and they graduated, then the 2-year work history is not a requirement.
Okay.
And when I say 2-year work history, I don't mean 2 years in the current job, 2 years overall. They could have had 2 or 3 or 4 jobs. The other exception that we have is if I'll give you an example of someone, let's say a woman that had a child and decided to take 3, 4, 5 years off to raise their child, and now they're re-entering the workforce. Well, as long as we can prove that they had a 2-year work history prior to having the child, then they don't need a current 2-year history.
Wow, that's great news, Mario. That's very good. Okay. Okay, very good. So there is hope. There is hope for those who are looking and have these questions. Now, another scenario. I have a client that we just recently sold a property. Their income is low. Now, he had a stable job, but he had an incident during the time that he was working. And of course, he had to go through, he won, I think, a suit or something, but now he's not longer working there, but he received some money due to the accident that he had at work, and he would like to use that money for an investment property. He is no longer working there, but he's planning to look for another job. Will this be possible for him to apply, or he has to have a job first before he starts to apply for his investment property?
He does have to have a job. He can have an offer letter. He doesn't have to start the job. So we're doing a loan right now where the borrower just started working for FP&L, and he hasn't even received his first check. We took the application before he even started his job because he showed us the offer letter. And we're going to close the loan without even him having his first check. Obviously, we have a requirement, and he has to agree to give us the copy of his first check after the loan closes. But we can do it. But in your particular scenario, the borrower will either have to have an offer letter with a start date and the position and the amount of income he's going to receive, or he has to have the job already.
Okay, very good to know. But I noticed that there has been changes throughout this time, even though we are still during COVID time. I remember during the peak of the pandemic, many have lost their jobs, and Luis and I had a scenario like that when I had a property under contract, the person lost their job and they couldn't purchase that property. We have to put it back on the market. So now, has that changed? Or even though, like, for example, this person, he had a letter saying that he was going to go back to work, but at that time he couldn't qualify for a loan. So has that changed?
Yeah, that situation would still be the same. The only way is if he had an offer letter with another company. He can't say he's going back to his recent employer. That wouldn't work. It would have to be either a new job or he actually has to be back in the seat already doing the job.
And still, even if the borrower, let's say, lost his job and he's claiming unemployment, that wouldn't qualify either, right?
Okay. You cannot use unemployment benefits to qualify for a loan.
Okay, very good, very good. These are very important questions that we come across with all the time, and it's always good to go back and see and explore, especially with our preferred lenders, to clarify and find solutions. Okay.
Yeah, I do want to make another clarification. We've been talking about first-time home buyers. There's a differentiator between Freddie Mac and Fannie Mae on the 3% down payment programs. The one for Freddie Mac is called Home Possible, and the one for Fannie Mae is called Home Ready. Home Ready requires one person to be a first-time home buyer. Freddie Mac does not. You can buy using the benefit with Freddie Mac even if you're not a first-time home buyer. Okay. So people, if you sold your home and you didn't net enough money to put a large down payment, let's say, and you wanted to make the minimum down payment, you could still do that under the Freddie Mac program.
Okay, very good, very good. Okay, and as far as investors, what are the requirements for them? How much down? And
it's going to be same credit score, minimum 620. And then right now it's 20%. It was 15, but ours changed to 20, and because of COVID. But everything else is basically the same as a regular conventional.
You'll be able to use future income on an investment property. So if you have a borrower that wants to buy an investment property and you as the realtor would give us a rent comparable showing that it's going to be rented, so let's say for $2,000 a month, we can use 75% of that $2,000 towards the qualification of the loan.
Okay, very good, very good. And the rates, how are the rates today? How are the rates right now? For first-time home buyers, or just primary borrowers, or
they're still very competitive. I mean, I would say in the high twos, and investment properties are going to be higher. That's probably mid threes and up, but they're still very, very, very competitive.
Okay. Now, another important question that we have daily from our clients and future clients. Um, should I wait until the election? Are things going to change because of the election? What is your point of view right now as professionals in the lending industry? What will that change? Will we continue, or how do you see that forecast?
Well, okay, so without getting political, right? I don't want to get political, but look, Walter Mercado is no longer with us, so we don't have a crystal ball. We don't know what the future holds. But I'll give you my personal opinion. If we have a Republican winner, the situation will stay the same or get better. I mean, other things are different, right? We're just talking about the mortgage industry. We're just talking about mortgage rates, and we're talking about financials, and we're talking about Mario Serrato's opinion. If we have a Democrat president, the think tanks, the pundits, the people that know way more than me, predict that we will not have as favorable a financial market, and that would include the mortgage interest rates. But who knows? I don't know. If you speak to, if you saw the debate, they say that that's not the case, but I don't know. My personal opinion is I hate having to sell homes or originate loans during an election year because it's so volatile. Because you know that the market is not really driven by anything but speculation. If people get scared, people do things. If people feel comfortable, they buy more. If they get scared, they hold on to their money. So it's really tough to predict. My hope is that the market stays about the same or gets slightly better. And I feel that is what's going to happen. I'm not so concerned about values. I think values are healthy right now. We're not seeing a lot of appraisals come back inflated. Although the market is competitive and there's certain price points that are ultra competitive, but for the most part, I would say that the market is stable from a value point of view, and from an interest rate point of view, we've been like this, right? Like this. Sometimes we go down, sometimes we go up, but we've been pretty steady. Depending on who wins the election, we'll see what happens. But I'll tell you this: here's what's going to happen. Something dramatic is going to happen for about 2 weeks, and then things will kind of normalize.
Okay, very good to know. Yes, as you say, we don't know, but we do know that the market today is moving really good. So if you have the opportunity to look at every single aspect of ideas that you have, if you can qualify to purchase a home, don't hesitate. Give us a call and we will be more than happy to help you in making your realty dream a reality. We thank you so much for your time and we wish you a fantastic week. Our information is on the screen. You can contact us at any time or find us through social media under hashtag realtormdavis or 954-869-0319. And remember, Monica Davis Group is your trusted real estate team. Have a wonderful afternoon. Bye-bye.
Bye.
Bye.
Bye.